Mark, huge issuance, and it's being met with a lot of demand. And for many people, it's a story of buy what the Fed is buying. Is that your approach to this as well?
Yes, Jonathan. Good to talk to you this morning. You know, we do see a pretty deep recession, so we're quite cautious on the market overall. But I think what's important to understand is that global monetary and fiscal policy response has been huge, and the Fed is now going to buy corporate bonds. They put in 2 new programs a week ago Monday to both buy secondary and primary corporate bonds. So this is a game changer. And we do think the higher quality spectrum of the investment-grade corporate bond market is attractive, particularly some of these defensive sectors like utilities, towers, healthcare, cable, telecom. But overall, we do think you want to be defensive, you want to be cautious. We are not expecting a V-shaped recovery. We think we're going to have something much more close to a U. And the bottom line is that you want to stay in high-quality companies and avoid some of these cyclicals and higher-levered companies now.
Mark, the Fed doesn't want to be in the business of picking winners and losers, but in essence, they're in the business of picking winners and losers. Are you expecting to see extreme bifurcation between the things where the Fed is present in investment-grade credit in the United States and the places where they're not?
I think, Jonathan, there are going to be more winners and losers. There's no question. Balance sheet strength is going to be rewarded. Companies that have liquidity, those are the companies that are going to be the survivors. The Fed is not buying equities. The Fed is not buying high yield. It's important to note for your audience that these programs will take weeks, if not months, to get up and running and operational and to be truly effective. We saw this in the 2008 crisis. These things take time. But what is important is that companies today are able to issue. You just mentioned last month in March we had $260 billion of new issuance. Remember, back in the financial crisis in 2008, companies were barely able to issue. Banks were not lending. And by the way, the companies that were issuing back in 2008, they were borrowing, high-quality companies, at 8 to 10% yields. Today, these companies are borrowing money at 3 to 5% yields. So the reality is that this is a positive signal, and you want to buy what the Fed is buying. That includes not only Treasuries and mortgages, but also the higher tier of the investment-grade corporate bond market.